Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about REX American Resources Corporation Annual Report. REX American Resources Corporation offers a diverse range of products and services. At the core of their business is ethanol production and sales within the United States. In addition to ethanol, they provide various byproducts derived from corn processing, including distillers' grains, which are used as animal feed. Their product line also includes distillers' corn oil, a valuable commodity in the food industry. Furthermore, the company offers gasoline and natural gas, expanding its reach into the energy sector. This comprehensive portfolio of products underscores REX American Resources Corporation's commitment to meeting the diverse needs of its customers across various industries. REX American Resources Corporation maintains a market capitalization of $1 billion, broadly in line with the industry peer group. REX American Resources Corporation trades at a lower price-to-earnings ratio of 18 times and a higher price-to-book ratio of 2.43 times relative within the industry. Despite the industry trading at relatively low valuations, the stock matrix does not show much. Investors should evaluate if the business has potential earnings that is sustainable and if the assets are valuated rationally. The balance sheet appears very conservative, with liabilities representing only 12% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has continued buybacks despite weak revenue growth, raising questions about capital allocation priorities. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline for a company involved in the production and sale of ethanol and its byproducts are multifaceted. On the growth side, an increase in ethanol exports, distillers' grains exports, and demand for distillers' corn oil due to favorable tax credits and low-carbon fuel standards, LCFS markets have contributed significantly to revenue growth. Additionally, improved pricing for distillers' corn oil and increased sales of ethanol, distillers' grains, and distillers' corn oil have also driven revenue growth. On the other hand, several factors have led to revenue decline. Decrease in price or demand for distillers' corn oil, inflationary pressures on production inputs, labor costs and expenses, trade restrictions, excess production capacity, decline in ethanol and byproduct prices, decreased market acceptance of distillers' grains as animal feed, rejection or delay of export shipments, negative impact on nutritional value of distillers' grains, increased competition from larger companies, and foreign competition from sugar cane-based ethanol producers have all contributed to revenue decline. The net income of the company underwent significant fluctuations between fiscal 2024 and fiscal 2026. Initially, it increased from $58.2 million to $83 million between fiscal 2024 and fiscal 2025. However, this trend was short-lived as it decreased to $71.486 in fiscal 2026. A closer look at the data reveals that there was a slight increase in net income from $75,924 fiscal 2024 to $82,951 fiscal 2025. The profit margins of the company also experienced changes during this period. The gross profit margin remained relatively stable at around 14.3% between fiscal 2024 and fiscal 2025. However, it decreased slightly from 14.4% in fiscal 2024 to 12.7% in fiscal 2025. In contrast, the net income margin remained relatively stable at around 9.1% between fiscal 2024 and fiscal 2025. A notable change occurred in fiscal 2026 when the gross profit margin increased from 11.8% fiscal 2024 to 14.4%. This increase was accompanied by a slight decrease in net income margin from 12.7% fiscal 2025 to 11.7% fiscal 2026. The reasons behind these changes are not explicitly stated, but they may be attributed to various factors such as changes in market conditions, operational efficiency, or strategic decisions made by the company's management. The company's financial performance indicates a positive trend in its ability to generate operating cash flow. The data from page 36 shows that the net cash provided by operating activities has been consistently increasing over the past 3 years. In 2024, the company generated $127,970 in net cash from operating activities, demonstrating a strong foundation for future growth. Although the figure decreased slightly in 2025 to $64,192, it still remained positive. However, the most recent data from 2026 shows a significant increase to $117,829. This upward trend suggests that the company is successfully managing its operations and generating sufficient cash flow to support its business activities. The consistent generation of positive operating cash flow indicates a healthy financial position for the company, allowing it to invest in growth initiatives and maintain stability. The company's debt level has undergone significant changes over the past year. While current liabilities have increased by a substantial 49%, long-term finance lease liabilities have emerged as a new liability, totaling $2,731. On the other hand, total long-term liabilities have decreased by 21%. This mixed trend suggests that the company is taking on more short-term debt while reducing its long-term obligations. In terms of interest expenses, there has been a notable increase in finance lease expense, rising from $0,000 in both 2024 and 2025 to $1,424,000 in 2026. This significant jump indicates that the company will incur substantial interest costs related to its new finance lease liabilities. Overall, these changes suggest that the company's debt level and interest expenses have indeed changed significantly over the past year. Management is optimistic about the company's outlook, citing opportunities in renewable energy and low-carbon fuels. The company plans to capitalize on growing demand for these products by expanding its portfolio of renewable energy assets. Specifically, management expects to increase ethanol production at One Earth Energy from 150 million gallons to 200 million gallons through expansion plans. In addition to increasing production, the company is also investing in carbon sequestration projects and seeking investment opportunities in related ventures such as energy-related and agricultural projects. Management believes that these investments will not only reduce the company's environmental impact, but also provide a competitive advantage in the market. The company is also taking steps to manage risk through forward contracts and futures agreements, which will help mitigate commodity price volatility. Furthermore, management is exploring opportunities for tax credits under various legislation, including the Inflation Reduction Act and One Big Beautiful Bill Act. Overall, management's strategy focuses on diversification, reducing carbon intensity, and investing in alternative energy projects. While regulatory risks are a concern, management believes that these investments will drive growth and profitability for the company. The company has made several significant acquisitions over the years to expand its business portfolio. Notably, it acquired NewGen Energy, LLC with a 99.7% ownership stake, and One Earth Energy, LLC and its subsidiaries with a 76.1% ownership stake. Additionally, Big River, LLC and its subsidiaries were also acquired with a 10.3% ownership stake. These acquisitions demonstrate the company's strategic efforts to diversify its assets and increase its market presence. In terms of divestitures, the company has made some notable moves as well. Although there are no divestitures mentioned in the earlier pages, it is worth noting that the company sold a refined coal facility on August 10, 2017, with a 95.35% ownership stake. Furthermore, after ceasing operations, the same facility was divested again on November 18, 2021. These transactions highlight the company's ability to adapt and adjust its business strategy as needed. The company has a history of rewarding its shareholders through both dividend payments and share buybacks. In terms of dividends, the company has consistently paid out significant amounts to its shareholders over the past 2 fiscal years, with $10.5 million paid out in fiscal year 2025 and $8.5 million in fiscal year 2024. In addition to dividend payments, the company has also been actively buying back shares from the market. In fiscal year 2025, the company purchased 1,651,000 252 shares for a total of $32.9 million, demonstrating its commitment to returning value to shareholders through share buybacks. With 2,357,186 shares remaining available under authorization, it is likely that the company will continue to pursue share buyback opportunities in the future. That concludes the financial summary for REX American Resources Corporation. Feel free to comment below, and I will be happy to answer them when possible.